Hi guys, welcome back to my channel, Kelvin here. So, a quick recap to what is happening in the world recently. The pandemic is showing no signs of stopping, and meanwhile, the market is doing this. GDP is expected to drop by 6.5%. And what's the market's reaction? Unemployment rate reaching sky-high levels, and protests are going on all over United States. And the market? It may seem like nothing makes sense anymore, and the market is just crazy. Or is there actually an explanation to all of this madness? Yes, there's actually an explanation. Let me just show you. Yep, that's a short explanation. You got what you came here for. But if you continue to watch on, I'll give you the long version of why the market is going up, even though everything is going down. Well, almost everything except for the pandemic numbers. Then I will also tell you how to invest in this kind of market. And I will also show you how I've been personally investing since my last portfolio video in March. But before I start, if you are new here, do subscribe to my channel. I post every Monday talking about personal finance stuff like credit cards and investing. Tap the bell button to get notified whenever I post a new video. And without further ado, let's start. The S&P had just touched 3002 recently, and even though it dropped slightly last week on Thursday, it had already made a sharp V for victory sign, making it one of the fastest recovery from one of the fastest drop ever so far. So why did it happen? As you have seen just now, the Fed had unlocked the unlimited money cheat code and has committed to buying up every asset class in order to boost the economy and the stock market. Even though it is future debt money, it is still money, and money moves the market. And the second reason is, you have to remember 3 rules by Paul Krugman. First, the stock market is not the economy. Second, the stock market is not the economy. And third, the stock market is not the economy. Why is that so? Just take a look at the weighting of the S&P 500. Tech companies like Microsoft, Apple, Amazon, Google, and Facebook represents 25% of the market. And that is not reflective of reality. That's why there's such a huge disconnect between the stock market and the economy. While so-called early cycle stocks like cars, banks, and consumer goods are more reflective of the economy. And third, the market is always pricing in the future. In other words, how the United States will look like 12 to 18 months from now. And right now, it is pricing in perfection, which means the market thinks that vaccines will be out soon, swift recovery of job data, and all businesses will reopen. And there won't be a pandemic second wave coming to a local community near you. If any of these predictions are wrong, like if the virus says, "I'm back," like the Terminator, it will completely wipe off all market gains, and we will be like, ah shit, here we go again. So with the market doing its weird bull run, and there's a potential crash right ahead, you might be asking, how should I invest? There's a fish that can answer your question. Don't worry. Be happy. Anyway, the real answer is, you shouldn't care what the market is doing in the short term. Let me show you why. If you compare the market against major bad events like since 100 years ago, you will have World War I and influenza, the 1929 crash and Great Depression, World War II, Cuban Missile Crisis, the Black Monday, or even recently, Asian currency crisis, the dot-com bubble, 9/11 terrorist attacks, the Iraq War, and the subprime mortgage crisis, and Brexit. There are way more worse-off events like World War II, where thousands are dying every day on the battlefield, and Cuban Missile Crisis, where United States and Soviet Union almost wiped out the entire world. And throughout it all, what had the market been doing? Yep, you guessed it right. As I mentioned so many times in my previous videos, don't try to time the market. Just invest consistently, and over the long term, you'll be fine. Don't panic sell if the crash comes along. You have to be calm and buy up whenever there's opportunity to buy. Like, can you imagine if we had bought Tesla when it hit the low points of 360 in March? We'll all be rich by now. So anyway, to show you that I put my money where my mouth is, not literally, I will now show you my portfolio updates since my last portfolio review during the crash in March. But before that, I want to tell you how my portfolio has evolved like a Digimon over these last few months. Originally, I started by buying dividend stocks with the goal of increasing my passive income so that I can retire in the next 12 to 15 years. Then later, I found out about index funds. If you do not know, index funds is just a basket of stocks representing a certain sector, like a basket of US stocks or a basket of tech stocks. I realized that a simple index fund which doesn't require me to manage it and is already well diversified was actually performing equally or even better than some of my dividend stocks. And so I started adding index funds to my portfolio. Then about 1 month ago, I discovered a whole new perspective to stocks. So the reason we invest in stocks is that we hope the stock price will go up, right? But what makes the stock price go up? Improving financials. But why does the financials improve? If you go to the core reason why the company is performing better and better, it is because the company is becoming more and more relevant. One example is Amazon. In 2000, its stock price was below $100. Then when the internet came along with all its funny cat videos and porn, when the internet came along with its e-commerce, cloud hosting, video streaming and so on, Amazon became relevant. It provided all of the things which the world actually needed. And because of that, its financials improved. Right now, its stock price is well over 2000 already. What I'm trying to say is my portfolio philosophy has shifted to buying stocks of innovative companies that will be relevant in the future. Because this kind of stocks will generally give the highest return over the long term compared to any other stocks out there. For example, Facebook, Amazon, Google, Apple, Tesla, and so on. As summarized by Katie Wood, fund manager of ARK Invest, who said, "The great thing about innovative companies is it is good at market downturn. Everything needs to be better, faster, cheaper, more productive, and more creative." After listening to me rambling a whole bunch, if you are still around, help to tap the like button to help support the channel. And because you are breathtaking. And now, here's the thing you have been waiting for, my portfolio update. I have grouped my stocks to the different philosophies which I've mentioned just now. Dividend stocks for stable income, index funds for consistent performance, and innovative stocks for explosive growth. So let's start with my dividend stocks first. Alright, so I have the two big banks in Singapore, DBS and UOB. Both of them give me a dividend yield of around 5% currently. I've added 100 shares of DBS during this period. Now, banks are good dividend stocks because people rely on banks a lot, especially when Singapore is a financial hub. We need banks for anything related to money, like buying a car, buying a house, starting a business, saving money, and so on. So Singapore's banks are extremely stable and it will grow together with Singapore's growth. The only thing they need to watch out for is digital banks. If DBS and UOB are slow to innovate, these digital banks will eat up their market share. Next, I have the commercial, logistic, and industrial REITs like Ascendas, Mapletree Commercial, Mapletree Industrial, Mapletree Logistic. They are giving me about 4% dividend on average. I've also added a bit of each REIT during this period. In the short term, these REITs will only be slightly affected by the pandemic. For example, Ascendas mentioned that 50% of its revenue are contributed by resilient industries like the banks, government sectors, data centers, and biomedical. And Mapletree Logistics mentioned that only 5% of its Singapore's tenants have been impacted. But over the long term, when there's finally a vaccine, it will just be business as usual. As I have mentioned before, these REITs are tightly linked to Singapore's growth story. For example, Singapore is a logistic hub. It needs warehouse and distribution centers for its businesses. In this case, the industrial and logistic REITs comes into play. And all of the companies requires office property to operate, which is handled by commercial REITs. So good stable dividend stocks right there. I'll be adding on whenever there's chance to do so. Next, I have two shopping mall REITs, Capital Mall and Mapletree North Asia Commercial Trust. Capital Mall operates more in Singapore while MNET operates more in Asia. I didn't buy more for these two stocks during this period. You will see that these mall REITs have higher dividend yield than the rest. It is not because the management is giving a higher payout. It is only because there is a drop in stock price. The retail sector will be hit the hardest during the pandemic. Like in Singapore, during the circuit breaker, non-essential businesses are not allowed to operate. For example, clothing stores, barber, cinemas, bubble tea shops all have to close, and it will affect the mall earnings by quite a lot. Even when the pandemic is over, I will still be cautious about these two REITs. First, Capital Mall currently has no plans to expand overseas, and this will limit its growth, which in turn will make its dividend growth stagnant. And second, MNET has most of its malls in Hong Kong. As you all know, Hong Kong's politics is very unstable right now. There are lots of protests and riots going on. I don't see how the retail industry can succeed when everyone is angry and scared. and unless these two malls improve themselves soon, I plan to sell them away in the near future. Next, for the index funds, I have IWDA and EIMI. IWDA focuses on developed countries like United States, United Kingdom, and France, while EIMI focuses on developing countries like China, Taiwan, and South Korea. By buying these two ETFs, I'm betting that the economy of the entire world as a whole will improve in the future. So if you're the type of person who doesn't want to manage your stocks, you can just buy into these two ETFs over and over again, because in the long term, you will see the economy of the world would have improved. Unless we have World War III, but that's a topic for another day. Next, I've also invested in the SSLK. It's essentially a basket of US tech stocks. Tech will be more and more relevant in the future, so I predict that the tech ETF will perform much better than the previous two ETFs which I've just mentioned. One thing to note though, SSLK doesn't have all the FAANG companies like Facebook, Amazon, Netflix, and Google. That's because these companies were too big and were all reclassified into S&P's new communication sector. I'm planning to invest in IGM instead, which is also a tech fund but has all the FAANG companies. Next are my innovative stocks, which I've been heavily adding on to my portfolio. For the first stock, I have Tesla, currently holding about 8 stocks with an average price of $740. I have made an entire 10-minute video talking about why I think Tesla is a good company to invest in. You can watch this video right here. But in summary, the world is shifting towards electric cars, and electric car sales will exceed traditional cars by 2030, and Tesla is way ahead of its competitors in terms of technology and market shares. Next, I've also added some Illumina stocks after watching Chicken Genius video. He has done a great job explaining why this company is promising. You can watch his video right here. But to summarize, Illumina is the leader in DNA sequencing technology. It owns 90% of the world's sequencing data, 75% of the global market share, and this company is well prepared to becoming the key player in curing illnesses. I'm not talking about curing illnesses by drinking medicine. Instead, it is curing illnesses at the DNA level. Same like computer programs, if you have access to the source code, you can fix the bugs or even improve the program. So in this case, if the gene editing technology is successful, you can cure illnesses which were previously untreatable like cancer and dementia, because you can remove the bugs in their DNA. Finally, I have the ARK ETF. This ETF is a basket of innovative stocks. They have all the promising companies like Tesla, Illumina, and Square. As I've mentioned, if you invest in innovative companies, you can expect a higher return in the future. But sometimes we just don't know who are the winners until it is too late. Like 20 years ago, no one would have known Apple would be worth so much now. So the best way is just to invest in an ETF that holds all the innovative stocks. You don't have to choose the winner if you choose everyone. And that's all for my video today. Hopefully it has given you some idea how to invest during this period. Like, share, and subscribe as I'll be posting new videos every Monday. See ya!